Welcome to the Captain's Blog. I'm Dave McDonough, Senior Vice President and founder of Flagship Wealth, powered by Trilogy. On this blog, we try to take what's unnecessarily complicated back here on Wall Street and make it understandable to you on Main Street. 6-week winning streak still intact, plus 1% last week. What happened? CPI, PPI, all the I's, inflation, came in lower than expectations or at expectations. What that does, it brings the Fed cuts back in. Markets pricing in September, maybe even an additional one by the end of the year. Again, justifying some, if not all, of the price increases. But what we did witness at the end of last week is what I like to call a sector rotation. Profit taking in the hottest sectors, while the boring value sectors are now in vogue. Did that sector rotation continue? Did the win streak continue? Here's your week in review. We'll answer that last question first. The answer is no, the win streak did not continue for the broader market, and I'll address that in a second. Down 1% as of this print. What happened? Again, the sector rotation continued. The FOMO, the tech stocks took it on the chin this week. I'm not smiling, but you may have heard on this very blog that it was time and it is healthy. The NASDAQ had one of its worst days in years. Semiconductor stocks had its worst day Wednesday in over 4 years. That happens to be the sector that the FOMO crowd and all of those that don't know how to pronounce the name or what that sector does was piling in. Now, what was the catalyst that prompted that sell-off? Former President Trump talked about Taiwan having to pay their dues. If they want our protection, they need to pay. And President Biden, same day, playing political tennis, said we need to be tougher on China. Now, folks, I believe it's simply an excuse for profit taking. And if you're proactive, and you are, if you're a viewer of the Captain's Blog, know that you've rebalanced. And although those growth sectors look great, there are other sectors. Small company, for example, plus 10% this month. You need to be there before the market gets there. You need to be proactive in your portfolios, or repeat after me, the market is going to do it for you. And here's what to look for next week. It is all about earnings next week. Corporations have to come out and tell you how they did and how they're going to do going forward. When you have a market priced at an all-time high, they need to justify their current price. I'm of the opinion that this is a buy the rumor, sell the news. What does that mean? It means that you're looking at the stock and you're looking at the earnings and you're buying in anticipation of good earnings. But when the good earnings come in, what's the next incentive? What is the next reason for that stock to go higher? Again, I think it's priced in. Look at other sectors of the market, the value sector. And again, do not chase. Here's your personal finance tip of the week. Repeat after me, class. Short-term money shouldn't be in the stock market. Thank you. As I just mentioned, tech stocks, semiconductor stocks had the worst day in over 4 years. Do not be calling your advisor and looking to sell positions in order for you to pay for something short-term. Plan it out. 6, 12-month money should not be in this market. Be in cash, be in CDs. Yes, I'm telling you to take the money, the short-term money, and don't give it to us. Don't have it in the market. Have it liquid. Again, what you don't need is to sell when the market's tanking. Be proactive in your portfolios. Be proactive in your planning. Consult your local financial advisor for more details. So thanks again for checking in. We'll see you next week on the Captain's Blog.